and welcome everybody to today's webinar. This webinar today is brought to you by OctaFX, the award-winning Forex broker offering some of the tightest spreads in the industry. Today we're going to start off a series of educational webinars. Today we're going to be talking about currency correlation strategies. This series of webinars we're going to be focusing on tools that are going to be able to help you in your trading and strategies that you're going to be able to easily put into action, and drawing from my 20 years of experience in the markets. Housekeeping: foreign exchange suitable for should not infuse. Secondly, a hypothetical trading disclaimer. The information in this webinar is provided as general market commentary and does not constitute investment of giving out specific recommendations. Let's talk about what we're going to cover today, guys. In this presentation, we're going to look at currency correlation strategies, and that is the price relationship between various understanding and ability. So first of all, let's talk about what is correlation. Correlation is simply a statistical measure of the relationship between security pairs. Currency correlation shows the extent to which two currency pairs have moved in the same, opposite, or totally random directions over a set time period. It's to which pairs diverge in opposite directions. And this is, as you can imagine, if there's a high correlation, very useful information, and can have, which is what. So on how two currency pairs have historically related to one another has predictive value, and can help you both identify potential trade setups and also manage your directional exposure to risk. Let's take a look at how correlation is measured. It's quite simple. It's just on a simple scale using a decimal form from -1 to +1, which gives you a figure referred to as the correlation coefficient. So a perfect +1 shows that the two currency pairs will move in the same direction 100% of the time. So you don't see that very often. A correlation of -1 indicates that the two currency pairs will move in the opposite direction 100% of the time, a perfect negative correlation. And then finally, a correlation of 0 implies that the two currency pairs move completely randomly. So what we know from this is that most useful correlation coefficients are those that are very high to the plus side or to the negative side. So 0.7, 0.8, 0.9 are really the more interesting ones, and the ones closer to 0 are not so interesting. So naturally, the stronger the positive or negative correlation, the greater the predictive value can be drawn from the analysis. And as with all other technical indicators, whether you're talking about moving averages or trend lines, the longer the time frame you're using for the analysis, the more meaningful the data. So when you're looking at correlations, if you're looking just over a 1 minute period, that's pretty meaningless, while the daily, weekly, monthly, and yearly data provide the most valuable insight, with the monthly and yearly being the most powerful indicators. Let's talk quickly about correlation tables. This is how you discover what the correlation relationships are between the currency pairs. So where you can find this is a variety of different free currency correlation tables available on the internet. Look for tables that can provide data across multiple time frames, because you're going to want to know what's been going on daily, weekly, monthly, and yearly. That's the most useful. And finally, you can also create your own correlation tables using Excel, and that's possibly in a later webinar. So now let's talk about why you want to learn about correlation and how it's going to help you. What are the advantages of using correlation? Okay, correlation can form the basis of a statistically high probability trading strategy, first of all. And we're going to get into specific strategies in a minute. Secondly, they can illustrate the amount of risk you are exposed to in your trading account. And finally, you can avoid positions that effectively cancel each other out. So if you you can effectively cancel your positions and lose money on the spread, so you can use your understanding of correlation to avoid this situation. So for example, buying two highly negatively correlated pairs, cancel the position out and effectively get you nowhere. So you can avoid that situation. So understanding correlations can help allow you to hedge or diversify your exposure to the market also. So in terms of diversification, if you have a directional bias, you can spread your risk across two pairs that have a strong positive correlation. So an example of this would be the euro against the dollar and the pound against the dollar, which have a strong positive correlation. Furthermore, if you're looking to hedge a position, hold it. With a low risk of loss, you can take a position in a closely correlated pair. So for example, if you buy the euro dollar and it starts to go against you, but you want to hold on to it, you can hedge that risk by buying a negatively correlated pair, such as the dollar against the Swiss franc. Okay, now let's get into specific trading strategies based on correlation. First of all, when two pairs are highly correlated, one can serve as a leading indicator to the price movement of the other. This is something I have experienced myself personally. Back when I was trading stocks, I used to have a very simple strategy where I would trade a stock called Cisco, and I would watch the S&P. And what I found was whenever there was a major move in the S&P, Cisco would follow suit. And my strategy was just basically to watch the S&P for moves, and then I would look for the follow-up move in Cisco, which happened a high percentage of the time. So in that case, the S&P was a leading indicator to the price movement of Cisco. There's a high price movement, and that's the strategy. If you're watching two currency pairs that have a strong positive correlation and you see a sharp move in one pair, you can anticipate a possible move in the other. This strategy is even more powerful when used in conjunction with another indicator. So for example, if one pair breaks out below a major technical level of support or resistance, the closely positively correlated pair has a high probability of following suit. So you see a major breakout in one pair, and the other pair that's closely correlated is going to be even more likely to follow in line with it. Price reversals: if you're watching negatively correlated currency pairs and you see a significant upward price reversal in one pair, you can expect the inverse to happen. So you can anticipate a potential downward reversal in the other pair. Finally, this is one we're going to talk about a little bit more in depth, which is an arbitrage type strategy using currency correlations, where you wait for a divergence between these two highly correlated currency pairs, and you buy one and sell the other. We're going to get into this in the chart, and I'm going to make this clearer for you guys. So you really want to have a highly correlated currency pair for this strategy. I'm thinking of like above 90, above 0.90, to minimize your risk. But what I like about this strategy is it's basically a non-directional strategy. It's a strategy where you're effectively hedged at all times. So again, you're going to want to look for currency pairs or a currency and a commodity that are very, very highly correlated. And when the two pairs diverge, in other words, they have a period of abnormality where they're not trading in line with each other, that's when you jump in, you buy one, and you sell the other with the expectation that they're going to come back and converge again. You may make money on both sides of the trade, on the buy and the sell. You might make money on just one. But the likelihood statistically is that they will converge again. Let's talk about some highly correlated currency pairs right now. Here's some examples of strong positive correlations looking at the yearly time frame, which again is the most powerful time frame, longer term time frames. So we can see that the euro dollar and cable, the pound against the dollar, had a 0.89 correlation coefficient, which is a very strong one over the prior year. Euro against the dollar and the Australian dollar against the US dollar had a 0.81 correlation. It's pretty strong. Here we see a really strong correlation between the euro dollar and the euro Swiss franc, a 0.93, and it's quite rare to see such a high correlation. And those two pairs might be an interesting one to experiment with the arbitrage strategy, since they are so highly correlated. Then we have famously the Australian dollar and gold have a fairly high correlation of 0.75. Let's take a look at some negatively correlated pairs over the yearly time frame. This one is a classic, the euro versus the euro. This has a very strong negative correlation. And when we pull up the charts in a minute, this will be clearly illustrated that they're basically doing the mirror of what the other is doing. Dollar CAD and Australian dollar against the USD has a negative 0.88 correlation coefficient. Australian dollar against the New Zealand dollar and the New Zealand dollar against the Singapore dollar has a negative correlation coefficient of 0.78, so 78% of the time those are direction. To pull up commodity here, dollar, yen, and gold have an inverse relationship with a correlation coefficient of 0.78. In other words, they move in 78% of the time over the prior year. Let's talk quickly about commodities correlated with currencies. The Canadian dollar and crude oil have a positive correlation due to the fact that Canada is a major oil producer and exporter. Similarly, the Australian dollar and gold have a positive correlation because Australia is a major gold producer and exporter. Let's talk about for a second how you might use fundamental analysis in a correlation strategy here. For example, every Wednesday, the crude oil inventories report comes out, and if that figure comes out way out of line of expectations, you can expect a big move in crude oil. So a strategy that you might experiment with is watching crude oil and the Canadian dollar, and you see a major move in the crude oil, you can expect there might be a possible reaction in the Canadian dollar. So they trade in line. So a move up in crude oil would be a move up in the Canadian dollar. You'd be trading probably the dollar, US dollar against the Canadian dollar, so you would expect a downward move off of an upward move in crude oil. Because when you're buying dollar CAD, you're buying the US dollar and selling the Canadian dollar simultaneously. Likewise, with the Australian dollar, if there's major news in gold, you might see a reaction in the Australian dollar. Let's talk about gold and Japanese yen. These are both viewed as safe havens in times of uncertainty, and they also have a high positive correlation. Meanwhile, gold and the US dollar typically move have a not so strong, but they do have historically a negative correlation. When the US dollar starts to lose its value amid rising inflation, this is the reason behind the relationship between gold and the US dollar. When the US dollar starts to lose its value amid rising inflation, investors seek alternative stores of value, such as gold. Currency correlations change, so you've got to be aware that the correlations are not set in stone, and currency correlations can change over time for a variety of reasons. So you have to keep watching the correlations over multiple time frames to stay on top of it. So the things that could make the currency correlations change include fundamental factors such as changes in central bank policy or other economic or political events. So for example, what's going on in the UK right now with Brexit might be something that could affect currency correlations. So as with any analysis of prior data, they're never a guaranteed indicator of future correlation or future performance. So that's just something to keep in mind. Nothing's set in stone. And with that, let's jump over to the charts and take a look at some examples of correlation strategies in action. Okay, so here we got MetaTrader 4. What I've done is pull up an overlay. So we have Euro USD here, and here we can see we have an overlay of dollar Swiss, and we can see that there is this strong negative correlation where the movement of Euro USD is mirrored with an opposite reaction in dollar Swiss. So this is one of the most famous relationships, one of the first ones that people think of when you talk about currency correlations. Wanted to quickly show you how to add this overlay tool. So you go to Open Data folder, go to MQL4, go to Indicators, and here's where you have all your custom indicators. Here's my overlay chart indicator. So you can, there's a variety of overlay chart custom indicators. You can pick one that you like from the internet, download it, and then you just copy and paste it into this folder. So again, MQL4 and indicators. And then when you want to add it, you just go to Insert, Indicators, Custom, and then you add your custom indicator. In this case, it's overlay chart. So that's how we get those overlays up there. And again, so we're looking at euro dollar and the dollar against the Swiss franc, and we can see this clear negative correlation. Going back to the idea of trading off reactions from one currency pair to the other, if you see when you're looking at a negatively correlated set of pairs like this, if you see, for example, an up movement in the euro dollar and you don't see the Swiss franc going down, you have a clue that maybe the Swiss franc may reverse based on this statistical analysis. Let's move on to dollar yen, and in this case I put it up against gold. So we talked about how gold and the Japanese yen are positively correlated. Gold and dollar yen are negatively correlated because, like my Canadian dollar example, when you're buying dollar yen, you're buying the dollar and selling the yen. So here we can see the negative correlation between dollar yen and gold, and again you could potentially develop a trading strategy off that, whereas you might see a big move in gold and expect a reaction in dollar yen. Here we're looking at this super highly correlated pair, which is the set of pairs rather, which is the euro dollar that we talked about and the euro against the Swiss franc. So this might be a candidate for that arbitrage strategy that I was talking about. We can see how closely they're almost in lockstep here, right? And then we can see that the pairs diverged here. I'm looking at the 4-hour time frame. Oh, this is the monthly time frame here. So you can see that they're astoundingly closely correlated here, but they do diverge to quite a great extent here. So if you were using that arbitrage strategy, you'd look for a big divergence, such as what happened here, and you would look to buy euro dollar and sell euro Swiss with the expectation that the prices are going to converge again, which they did here. So during this period you wouldn't have much of an opportunity because they're trading in lockstep. So again, you're looking for an abnormal level of divergence between these two sets of currency pairs for your opportunity to come up. Euro dollar daily versus this is the British pound. So we talked about how euro dollar and British pound had a very high positive correlation. We can see that illustrated in this chart here. And again, a trading strategy that you could employ is perhaps trading the British pound off moves in the euro dollar. If you see a major move in the euro dollar, the probability is that the pound will follow suit. Cable dollar pound against the dollar will follow suit. Okay, now we're looking at the Australian dollar and gold again. Australian dollar and gold, like we said, had a very high positive correlation. So we can see that these almost throughout this time period, I'm looking at the daily chart here, moving in lockstep very often and providing potential trade opportunities to traders who are watching this very closely for divergences and possible opportunities to jump in on sharp moves in one or the other of the currencies pairs. Finally, I pulled up Bitcoin and Ethereum, and as you can imagine, these two securities move very closely in line. In green here we have Bitcoin, and this is Ethereum. Here again we can see they're moving totally in lockstep. We had some divergence here. I pulled up a shorter term time frame to illustrate this one. But again, we can see that there are periods of abnormality where they diverge, and this is another set of pairs that you could employ that arbitrage strategy with potentially. I think Bitcoin and Ethereum are particularly risky trades. I mean, you can see this huge sharp move down here, but since they're so closely related, they make an interesting study. And another thing I like about Bitcoin and Ethereum is that you can kind of tell which one is likely to lead the other. Since Bitcoin is bigger than Ethereum, you would expect Bitcoin to lead and Ethereum to potentially follow suit. So again, if you were looking to employ the arbitrage strategy, you would be possibly buying Bitcoin and selling Ethereum when they have an abnormal divergence, with the expectation that they're going to come together again, and you could get out of your long position here and short position here. So if, let's say, I bought here and I sold Ethereum here, I would have made a profit on my Bitcoin, and I would have just about broken even on my Ethereum. So that's the whole idea behind the strategy. You're looking at the past statistical data that such and such pairs have traded in line such and such percentage of the time over a set time period. So that's what's giving you the expectation that they will converge again. But not, like I said, nothing is set in stone, and then big abnormalities happen here, such as major spike down in Ethereum. So with that, guys, I want to wrap it up. I want to thank you all for coming. If you have any questions, please do let me know. Webinar at OctaFX, and I look forward to seeing you again in the next session. Thank you again.